Hello, this is Brian Lyson with Financial Brokerage, and today I'd like to share a real simple sales idea that you can make on a napkin or a scrap of paper, and it's going to lead to it should lead to a large life insurance sale, specifically using a life insurance policy as part of the whole retirement planning process. And I would like to say thank you to one of our partner insurance companies that shared this idea with us a while back. And Joe, if you're watching, I appreciate it. It's a fantastic idea. All right, so you get your napkin or your scrap of paper with the client, and you want to write three numbers down. You want to write down $5, $10, and $20. And then explain to your client that these numbers represent your retirement plan and the money within that plan. Now, that money is going to go through three phases. The $5 represents the contribution phase, the money you're putting into the plan. The $10 represents the accumulation phase, or what that money will grow to between now and the time you retire. And the $20 represents the distribution phase. That's the money that you're actually receiving during your retirement years. Now, if your retirement plan looked like this and then ratios worked out like this, that would look pretty good and you'd be happy once you hit your retirement years. Well, I've got to tell you, there's good news and bad news that go with these numbers. The IRS says that you have to be taxed on one of those numbers. The good news is you get to choose which number you'd like to pay the taxes on. Now, just ask your clients, which number would you prefer to pay taxes on? I guarantee you, they're going to point to the $5 right there. But then you want to ask your clients, well, where is your retirement money right now? And most often they're going to say it's in an IRA, it's in a 401k, maybe a 403b. Well, you might want to explain to them how the taxation works on those retirement plans, because the choice they've made already is to be taxed on this figure down here. Now, assuming we look at the time value of money and tax rates don't change, this probably all works out evenly one way or another. However, what do we know about the federal debt and tax rates right now? Well, we know the debt has really never been higher, and historically our federal income tax rates are at a low point. So what do you think is going to happen with income taxes in the future? I would surmise that they're going to increase. That being the case, it would make more sense to pay our income taxes today rather than later. On top of that, look at all the deductions your clients enjoy in their younger years. If they have children in the household, there's a deduction for children. If they pay interest on a mortgage, they're getting a huge deduction for that. Those deductions are going to go away. So even if taxes stay the same, they're losing deductions, and at the same income level, they're going to pay more income tax to the federal government. Again, wouldn't it make more sense to pay the taxes today when you have all of these deductions and you know what the tax rate is? All right, so that being said, there's just a couple of places where you can move your money, your retirement money, and enjoy taxation on the front end and nothing on the back end. So those vehicles would include a Roth IRA, a Roth 401k, or a life insurance policy. Now, there are some differences between those, and I would put my money into the life policy for a few reasons. One, the Roth products are going to limit how much money you can put in there. A Roth IRA limits your contribution to $5,500 per year right now. There are also income limits. If you make too much money, you can't contribute to a Roth IRA at all. We don't have those restrictions on a life insurance policy. And there are some other restrictions that go with the Roth products when we look into accessing the money. With the life policy, we can access the funds tomorrow if they're in there. We can wait till we're 80 years old to get to the money. There are no penalties in between. And on top of that, since we're talking about a life insurance policy, it includes a death benefit. So when the client passes away, they're not just passing on the account value, they're passing on the death benefit, which is always going to be much greater than the account value. So next time you're sitting across a client at the coffee shop, or you're at the table, you've got a scrap piece of paper, here's a real simple idea you can use and have an entire retirement planning conversation with that client.